Welcome to the Roy Matlock Jr. Money and Business Hour. Reach Roy at 615-843-2999 or visit roymatlockjr.com. And now, here's Roy.
Roy Matlock Jr. here, and we are talking money like always. If you're just tuning in, I would encourage you to, listen and learn because education is valuable. I think most of us would agree that the old saying, what you don't know won't hurt you, doesn't apply to your money. And I was on a meeting this week about a kind of a counseling company, and what they do mental health counseling. And we're talking to him right now about adding financial. And the reason is, he brought it up that he said the number one stressor people have pretty much in their life is their money. And so if you're tuning in today, I'm going to give you kind of the how-to that when we meet with someone, many people avoid planning because they think they're going to be sold something. And there are guys out there and gals out there that do that. But what we're going to do is kind of walk you through the mystery of what actually happens in a meeting. I'm going to walk you through, without naming names, obviously, some case studies of types of things that we do when it comes to people. I was I just did a call this week and with someone that, I did several meetings, and I still do those. And I'm going to kind of give you an outline of what happens when you have it going in the right direction and so on. So anyway, so this is what we would do if we were going to do a review. And what we know is that you don't need more products, you need more clarity. And what clarity means is that when you meet with one of the advisors, we're not going to talk about a product. We're going to ask questions. And so when I typically meet with someone, I'll find out a little bit about you. And what I mean by a little bit about you, where you're from, what you do you have children, that kind of thing. And then generally the first question is, what are your number one challenges that you feel like you've got right now when it comes to your money? And secondly, what are some of your goals that you'd like to accomplish? And it's interesting when I do that, most people can tell me immediately, why did you set the appointment? Why would you pick the phone up right now and call us or to schedule a review? And the reason you do it, you got something on your mind. And typically you've got something on your mind because something has happened. I can give you some examples. You got married, you got divorced, had a kid, somebody died, you changed jobs, you bought a house, or you're considering buying a house. You, if you're a business owner, taxes are bothersome. You've got employees that, you'd like to keep. You want to compete, and you think about benefits and, all these kind of things. Your health insurance premiums just went up. What am I going to do about it? So there's always something. You inherited money. I can go on and on. You're thinking about selling your business. You don't know what it's worth. And so when I speak with people, the first thing I do is, hey, what's bothering you? And I'll get something usually falls in that. Oh, I've accumulated some credit card debt and I was doing good. And now I got this credit card debt. What's up with that? Or, they're wanting to retire and they're trying to figure out how much income they can get. It just goes on and on, but it's always something. And so one of the things I've always believed is that, my job as an advisor is to educate people, keep them educated, deliver educational materials. My daughter sent me I play a lot of golf, and my daughter sent me this thing that said, this is going to be you. And it was this guy, he was 100 years old, and he's still playing golf, and he's still taking lessons, and he's still, out there working out, trying to do stuff. And I said, yeah, that's pretty much the way it is with me. I'm always self-improving. I'm only good at a few things, and the things I'm good at, I'm always spending time getting better at it by reading and things like that. So if you're not on my email list and receiving information from us, then you're missing out on that. We have not only do I send out emails on a monthly basis that give you updated ideas and things of that nature, but also, and it's all educational. It's never, trying to sell something. I'm not in the selling business. I'm in the creating financial independence business. And, there are products that have to go along with that. But the whole idea is that let's find something that helps you reach your goals. And then from my standpoint on the product side, we have access to everything. So we're not tied to any one company. I think right now the investment choices we have are about 9,000 of them. So it's pretty much yes. The answer is yes. Yes, we have that. Yes, 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 we have that. And on any of the protection side, we've got access to all the different companies. So it's never that. It's more, let's get a plan in place. And so when we start with a review, the first thing we're going to do is we're going to take a look at where you're at. And that would be, here's the questions. So now that we know a little bit about you, if it's okay, I'd like to ask you a few questions. And those questions will give me a better understanding and I can give you some good advice. And then worst case, if you meet with one of our advisors, then what you're going to get is some good advice. And most every time when I meet with someone, I can give them something that they can implement easily, not being in a relationship with us. They can implement easily just from the advice standpoint, and it will make them a lot of money. And what are some of the things we do? I see people all the time that they have access to a 401k and they're not doing it. Or maybe they have access to a 401k and they're not fully funding it. They think 6% is fully funding. No, it's not. You can put $20 to $30,000, depending on your age, in your 401k, plus you get your match. And then you say, well, now save the taxes. All right, well, I didn't set up my account, my withholdings to get the tax refund now. Well, then you get a big tax refund. So you loan the money to the IRS for a year, tax free. Instead, what we could do is raise your exemptions, raise the contribution you put in, all the money that you save in taxes. We could fully fund a Roth IRA out of that potentially. And so there's stuff like that. I see business owners that are, not taking advantage of, like health savings plans in many cases, and individuals doing the same thing saves you a lot of cash. And so we just go through and we start out with kind of a review. And so what I'm going to do when we come back from the break, I'm going to walk you through the questions I ask. All right. If you were to sit down with one of our advisors, and then what we'll do is we'll go through the process. So what's the process? Advice and education, number one. Number two is we're going to take a look at your defensive positions. That's to avoid mistakes, protect your income, protect your assets. Then we're going to go into the offense, and that's going to grow wealth and cut taxes. And then from there, we go to the product marketplace. And then from there, we review on a regular basis. That's what we do. So I'm going to ask you the questions. You can listen up as we come back. My name is Roy Matlock Jr. Visit roymatlockjr.com if you would like to get a review or any of our free resources. We'll be right back. We're in segment 2, and today is what would it be like if you were to meet with an advisor and with us, and how do we go about doing things? I'm very focused on getting people educated, make sure that they can answer questions and could tell their friends or family what they're doing, and so it starts out with some good questions. And one of the things that I always want to know when I'm talking to someone is, what are your goals? What are you trying to accomplish? And I have that, happening on a regular. That's what that people can usually tell me. Hey, I'm just don't really feel comfortable, that I'm doing the right things with where my money's invested, or, I've got a 401k that's been sitting, or I don't know how to. I don't know if anything happened to me, what would, if I became disabled or lost or something happened to me, how my family would be taken care of. And I would ask them, number one, what's the goals? And number two, what's keeping you up at night? What are you worried about? So what are the challenges that you're dealing with right now? And it's interesting. People will open up and tell me that. And generally speaking, the majority of the time, I probably have an answer. I mean, I've been doing this for 41 years, meeting with people. I have access to pretty much anyone in the know when it comes to your money. So we do certain things. We refer other things. I met with a client, did a phone call, and one of the things that we did was we referred him to a CPA that there's a business owner. And I cannot tell you how many times I have reviewed someone's tax return. And the first thing I do is I say, well, the first thing we need to do is find you a CPA that's actually giving advice. All right. Not just filling in your forms. And so, if you meet with, tax preparer and they're not telling you something that could get you tax savings or a better result, then you are dealing with someone that is a tax preparer, not an advisor. And so I see that all the time. And I'm like, well, the first thing we need to do here, based on what you've shown me, we need to fire your tax person. They don't know what they're doing. And I can tell you story after story, especially if you're a self-employed business owner. So once we start doing that, we start digging into the questions. And I'm going to start with the first question, which is, let's talk about your income. One of the things that I like to talk about is income, because your income, at a very minimum, you need to figure out a way to get your income to keep up with inflation. Or another way you look at it, 100,000 today was 50,000 20 years ago. And so if you were making 50 20 years ago and you're making less than 100 now, then that means that you went backwards just on your income. And it's very difficult if your income is not keeping up with inflation at a very minimum. It's very difficult to continually move forward, because as inflation kicks in, your excess cash flow just gets tighter and tighter and tighter. And every time I've talked to people, they always choose food over mutual funds. All right. And Roth IRAs and stuff like that. So we want to work on our income. How do we work on our income? You got to just, if you're working for a company, sometimes they forget how good you are. And then you go somewhere else and you find out, hey, maybe I'd make more money, whatever it may be. And so what I've always tried to do is incentivize every way I can to keep my good people. But not every business is like that. And so what you want to be thinking about is, when you are in the workplace, you want to be valuable to the point that the company that you're working for is scared you're going to leave. All right. And if you do that, how do you get valuable? You just get better. And then the goal being is get your income to a point where you can save 25% of it. 25% of your income really gets you going. A very minimum get by you need to be thinking is, I'm going to put 10% of my money away towards something. So then we would start, and I would ask the first question, which is, do you own your home? If you were to sell it today, what would you sell it for? And you tell me that. And 500. All right. And what do you owe on it? Oh, 200. Do you have a good interest rate? Yes. Do you have an equity line of credit in the event that something happened, you needed additional money? No, we need to set that up right off the bat. Let me give you an example. People that bought houses back 5, 6, 7 years ago, they've got a lot of equity. That equity is of no value if you don't have access to it. If you lose your job and you have a house that you've got 50% equity in and you don't pay the payment next month, you can get foreclosed. All right. So keep that in mind. So we always do that. So I'll start that way. If you have a low interest loan, I'm going to tell you, don't pay it down. That just makes no sense. If you pay a 3% loan off, you're getting 3% return on your money, and you're tying your money up. In order to get it back out, you have to borrow it. So just let it ride. It's gold. Keep your 3% loan, never pay it off. Do you have cash reserves, bank accounts? Yes. How much do you have? We would look at that. Depending on what's up. I met with a client this week. He's doing really, really good. I'm going to tell the story, brag on her. But the point being is that if you have credit card debt and you have money in the bank, then, let's pay the credit card off and keep $1,000 in the bank account. I see it a lot of times. People have 10 grand in their bank account and then they turn around, they have a credit card debt of 10 grand. And I'm like, well, I don't want to get rid. Well, you can always re-borrow the money on your credit card, but the difference is that if you have 10 grand on a credit card and 10 grand in the bank, you're losing about 18, 19, 20%, which is 2 grand a year in interest, and you just swap it. Okay. And you automatically make money right off the bat by, taking the 3% money or 2% or 1% money and applying it toward the debt. And if you apply it toward the debt, what's going to happen is that you're going to get the rate of return you're paying on the debt. So for instance, if you pay money toward a 3% mortgage, that's the rate of return you got. If you pay money toward an 18% credit card, then paying it off, you get 18%. So that's the mindset there. So I'm going to look and I'm going to say, hey, what do you have? You have a mortgage? Yeah. Do you have any other debt, cards, credit cards, anything like that? What are the rates? And then I'm going to look at the emergency fund and see if there's money set aside. I always tell people, let's keep $1,000 and apply it toward high interest debt, or what we call bad debt. And so now we're getting some advice. You're sitting here, so, well, how did I get my credit card debt? Well, you spent more than you made. That's pretty easy to understand. You spent more than you made. So what does that mean? That means you need to work on the budget. How do you work on the budget? Well, you go to roymatlockjr.com, you go to resources, and you download the budget form. You then figure out what it costs for you to live. You look at your expenses one by one and say, if I didn't have this expense, would I rehire it? And you say no. And then if you can get rid of it now, you get rid of it. That cuts your cost. And so we're going to analyze all these kind of things. And so once you get the budget in place, you're able to spend, you're going to consistently in advance spend less than you make. And now you've got a reserve coming up. You get your deductibles, you raise those as a result of having an emergency fund that saves you money. We can reinvest the deductibles on life, not on life, but on health insurance and home insurance and car insurance. And then we're going to go and raise our liability coverages so somebody can't try to steal our money from us, by some kind of lawsuit, that kind of thing. So then we're going to ask things like, what about retirement plans? Do you have a retirement plan at work? Yes. What's the balance? And you give me the balance. And then how much are you contributing to that? And we find out they're not fully contributing based on what their income is. So we've got that. So we're starting to learn. I'm learning more about what's up and giving advice along the way. I'm giving you advice right now. Some of you are listening. You're saying, yeah, I got a tax refund. I was so excited about it. Really? Well, thanks for loaning the IRS, $4,000 last year at 0%. Why wouldn't we just raise our exemptions? So I go through all these kind of things. We find out any other retirement plans from a previous job. I see people that have never looked at their retirement plans, never looked at them. They left the job. It's been sitting there for 10, 15 years. And I've seen disasters. I saw one example that over a 20-year period, based on had they been with me, it would have made them over $100,000, but they had their money sitting in a previous retirement account through a school system, never looked at it. It was in a fixed account. It's that kind of stuff. My name is Roy Matlock Jr. Keep listening. We're going to give case scenarios. Visit roymatlockjr.com. We'll be right back. All right. If you're just tuning in, we are doing a financial review. And as if you were sitting with me or one of my advisors, you would be, this will give you an idea how this works. And so what we're doing now is we're finding out, doing a little income, find out where you're at income wise. I know you've got 2 kids. I know how old you are. I know what you're making. I know what you own a house and how much you owe on it. I know it's a low rate. We're going to get you an equity line of credit. We're going to work on the emergency fund. Got some credit card debt. We're going to apply low interest savings to the credit card. If you have credit card and you don't have cash set aside, we're going to have a goal of maybe having $1,000 of cash. And then we're going to set up an automation on your credit card. What do I mean by automation? We're going to put aside, there's a couple things. I had a question, do I pay off, equal or whatever? We can debt stack. There's a lot of different ways. Debt stacking is you pay minimum payments on all your credit cards and apply a fixed amount of money toward the next or the smallest balance until you pay it off. One of the things on credit card, getting out of debt on credit card is first thing you do is you set up an automation. So let's just say you've got $300 a month you're going to apply to a credit card. So you go to the credit card company and you set up a $300 a month debit that happens $300 a month every month. Now, if you don't do it that way and you pay minimum payments, then the payments go down, it refinances out, takes 27 years to pay your credit cards off typically. So what we want to do is just set it up and automate it, and we come up with it. And then we can look and say, hey, I'm putting $500 a month toward this one, and I'm going to just pay a set payment, whatever the minimum payment is, but automate it so it doesn't go down. So if the automated payment's $50, I'm going to pay $50 a month every month. And then that way I'm applying more to principal. And then I'm going to take the extra money, the biggest one, and I'm going to knock out the smallest debt. And when it happens, I'm going to apply it to the next one. Then you can debt, stack if you want to do something like that. But the long and short of it is that you want to start narrowing the number of cards if you're in debt. And then you want to always have set payments. So if I run into that, hey, there's advice. And if you want to know more about that, go to roymatlockjr.com. Go to the Roy Matlock Jr. Money and Business Hour podcast. But if you go on the website, you can actually search keywords to find what's going on. So then we're going to look at your insurance. I'm going to take a look at your first year insurance that protects your income. That would be your term life insurance. If you don't have term life insurance, there's no excuse for that. If you have families or people dependent on you, buy term life. It's cheap. All right. We have 40 companies that we shop. In addition to, we have coverage that we can issue you in 10 minutes with no physical. And it even includes a will and a trust. We have a service that we do that. You can find that out at roymatlockjr.com and literally knock it out, take that off the table. If anything happened to you, you're in business. And so your family is. And so we would go in and do a review on your insurance, your life, your disability. That protects your income. We would protect your assets. If you are buying your own health insurance, then we should look at, what your deductibles are. Are you buying a health share? Do you have a HSA? Whatever it may be, to cut cost and pay attention. I looked at a difference in a health savings account tied with a health sharing, and it was the difference for a family of 5. They were in their 50s, had 3 kids, $2,500 a month versus $900 a month. And then you invest the difference into a separate account. You can do an HSA, whatever it may be, get a tax deduction. I mean, there's all these different ways of doing stuff, but we look at that stuff. And then from there, we look at, like the home and auto, many cases, raise your deductibles, buy an umbrella policy. We have referrals for that to do a review. You want to go in. I did a show recently just on buying insurance, all right, and how to do it. And so we do those kind of things. Once we get that in place and we find out what's going on, then we'll go out and we'll shop around and make sure you're doing the right stuff. Estate planning is a big deal. Will and trust, financial power of attorneys, healthcare power of attorneys, living will. That's if you're on your last breath, whether or not somebody's going to keep applying life support or not. You don't want to leave that to your kids to make that decision. So you've got all those kind of things. If you're at or near retirement, we're going to look at income planning, long-term care concerns. We'll look at investments, allocations, and any goals that you have after you are gone. All right. So let's talk about some examples. I had a client I met with this week. Her family is a client of mine. We started college plans, got those things started. She was able to get through college and has a good job. And we met and we got 401k started along with about 20,000 that was left over from the college plan, all in growth funds, automatically deducted out of the account. We have a Roth set up, and at 26 years old, she's got 80 grand saved. Can you imagine? How good is that? All right. And reached out to the parents. I said, hey, she's doing good. All right. And that's the kind of stuff that you would like to be able to say, all right, that your kids are doing great. They got educated. That's what happens when you have a legacy of financial advice. One of the things that I do is do something, and we did it in a major way. I think we had about 4,000 people jump on, and we'll probably do it again. We call it the Family Financial Workshop, and that's where you bring your teenagers and your young adults, kids, onto a webinar that we do, and that webinar is designed to get the basics started. All right, so what's the basics of getting started? Rule of 72, understanding how compound interest works. All right. That says any interest rate you divide it in the number 72. It tells you how long it takes your money to double. If you look at what's been going on in the stock market as of recent, the last 3 years, I'm looking at funds that people are in the accumulation stage that have averaged 25% a year for the last 3 years. That's the kind of stuff we put people in. And so, it doesn't always do that, but I can assure you that if you're getting 4 and there's places to get better than 4, you should do it, because you don't have to work for it. All you got to do is get it started. Typically, if someone's young and getting started, I tell them it's simple. We're going to protect your income and and grow wealth. How do we protect it? Well, if you have liabilities, what are liabilities? You've got kids, you got a mortgage, you got all that kind of stuff. We're going to go in and set up term life insurance. You can get $1 million of term insurance for less than $100 a month if you're young. No reason to not do that. That way, if anything happens, you're going to be covered. How do we calculate it? We just say, what do you earn? And what are your debts? And if you have kids, you want to set aside money for college, and we do that. So to pay your debts off, your mortgage off, if you want to leave that behind, we add that up. We estimate what college might cost. We do that. And then we look at your income and we say, what's the present value of your income? And what I mean by present value, if you're making 50 grand a year, how much cash would we need, say at 7 or 8%, to be able to provide a $50,000 income, for however many years? And we go in and we do that kind of stuff. And so the whole idea is automate. What is automation? Automation is that I meet with you. We set aside money monthly. We would take advantage of your Roth IRA when you're getting started, as well as your 401k, and get your matching funds. And now you are automating your financial independence. So what do you mean by automate? Well, let's draft $500 a month every month. 10 years from now, you got 100 grand ballpark. All right. That's automation. So you want 100 grand? Yeah. Let's just call it up. 10 years from now, 500 a month. We got 100 grand. Then we have 100 grand that's growing, and we do another 500 a month for 10 years. We pick up another 100 grand. But while we were getting that other 100 grand, that 100 grand has already doubled 1 or 2 times. All right. And now we're at 500 grand, and we're like, hey, this is cool. All right. And we put it into investments that have growth. That's the way we get started young. If you're just tuning in, you'd like a financial review, visit roymatlockjr.com, or you can call us, do a quick phone call, 615-843-2999. And we have one more segment. We'll be right back. All right, we are finishing up, and this is a real-life financial review is what this show is. And if you are listening right now and you're wondering what we really do for people, we ask questions. We educate, we give advice, and if you feel like you've been meeting with someone and they're trying to sell you something, then you need to, look elsewhere, because that's not what the goal is. It's no different. I do a lot of things. I've had a doctor. I mean, I always tell people my doctor is he's like an auto mechanic for your body. The dude he knows I can't ask him anything he doesn't know definitively what's going on, and very preventive oriented, that kind of thing. And I meet every 6 months, and I get blood work done. I do all that kind of stuff. And I've been doing it for probably, I think I met him 18, 19 years ago. And we do, it's easy. I go to get blood, and the blood comes back. We do a phone call. We do a review. He keeps me optimized. If I ever have any questions, I'll give you an example. I called him and I said, what do you think about this COVID vaccine? And he's like, nah, don't do it. Okay. It's more risk in the COVID vaccine than there is in that. And so I didn't do it. All right. And I'm glad I didn't do it. So, the reason I bring this up is because, if you want to get better at anything, first thing you do is you get with people that know more about that subject than you do. All right. So I don't do my own taxes. I know a lot about tax. I mean, I know a lot about self-employed tax. I know a lot about retirement plans, do a lot about that, but I also have a tax advisor that I use, and because they know things I don't know, because that's not what I do. And so I have a team of people like that. I play competitive golf, and I have a guy that I take golf lessons from. And the reason I do that is the guy, he can watch my swing, and he can tell me what the TrackMan, which is the machine that tells inside out, outside in, spin rate, he can tell me that just by watching. All right. Because that's what he does every day. That's his life. All right. And so even the greatest golfers out there have coaches. All right. And the reason is that it allows someone to look at you and be not emotional. They just go and they just look and say, why are you doing this? What are you doing? Here's what you need to do. Da, 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 da. And that's kind of where I'm at. And so on the financial advice, think of it the same way. So when we're talking to someone, we're doing a review, we're doing an analysis, and we're making recommendations. And our recommendations are not product driven; they're advice driven. That products fill the need for the advice, and that's the way we go. So let me give you an example. Here's a 45-year-old, 2 kids, got a mortgage, got 300,000 in the 401k. You're like, wow, that's pretty good. 40 years old, they've accumulated, 300 grand and no debt outside their mortgage, got a decent interest rate on their mortgage. And we start looking, and I said, well, we got a couple of issues here. You're way, way underinsured as it relates to your life insurance. Now, why has that happened? Well, we've had inflation. And I think everyone would agree that the cost of living has gone up, and your life insurance has not gone up in 10 years. So therefore, the 300,000 is going to give you about 1,000 a month of income replacement, and that's spending the retirement plan you've got. So we don't want to do that because that's designed for retirement. You got 2 kids, something happened to you, you've got kids to raise, you got a mortgage still, that kind of deal. So we would do a life insurance review. We would check and make sure that the disability income is in place, either through your work or you get it on your own. I meet and I find out that you meet with a person and they have no written plan whatsoever when it comes to estate planning. I'll never forget I was playing Little League Baseball, and a guy became not an orphan, but he lost both his parents, and he was on my baseball team at like 10, 12 years old. And can you imagine that? Both the parents were killed in an auto accident. Do you have a plan in place that would, make sure that, if you have children, that they would be properly taken care of? They're minors too. And if anything happened to both of you, you would need to have something in place. That's what a living trust does. That's what financial power of attorneys do. So that way, if you were in a wreck and you were, laid up and you couldn't pay your bills or anything like that, you would have all of that. Those are estate planning documents: financial power of attorney, healthcare power of attorney, living will, living trust, all those kind of things. Last thing you want to do is hand off a bunch of money. You're gone and you have no control over it to someone that doesn't know how to handle it. So that's why you have a trustee, somebody that oversees that kind of stuff and make sure that everything's in place. We do beneficiary reviews. Why do we do that? Because 50% of the population gets a divorce, and I can't tell you how many times the beneficiaries never got updated, and the ex-husband, ex-wife becomes the beneficiary. You get remarried, and then you have kids on both sides, and then who gets the house? Who gets the assets? Does it transfer, from one spouse to the other, and then the kids get locked out? So I go through, and when I meet with people like that, on the outside, you're like, man, it's great. All right. But we've got stuff that we don't have in place. We've got, home and auto insurance that have the minimum coverages required by the state. So if you hit a Mercedes or a nice car, you're going to end up owing money out of pocket. You have assets that you want to protect. You need to have an umbrella policy. So all of these things go into it. Are we maximizing our retirement plans? If you're out there now and you don't have an advisor, one of the things that I always do is say, step number 1 on your 401k, open it up, start putting money into it. At least get your matching funds. All right. Should it be a Roth? Should it be a deductible one? That depends on, early stage, late stage life, income compared to what it's going to be. Typically, rule of thumb is if you're young, the Roth will make more sense. If you're older and you're a little behind, all right, then, and your income is up, then what we're going to do is probably take the deduction. But that is, again, a decision where we just look at the numbers and decide. So we're doing things like that. So here's somebody that's 40 years old with 300 grand and a mortgage and a house. And you're saying, I didn't think about all those things going on. Well, yeah, that's why you meet with an advisor. All right. We start looking at that. Do you have any educational savings accounts, 529 plans? What are your investments invested in? one of the rules, if you're doing your 401k, just take your birth year and add 65 or 70 to it. And that will give you what's called a target date or a lifestyle, whatever it may be. So if you were born, if you're 25 right now, 26 years old, you're born in 2000. So you would look and say, give me a 2070 plan. All right. And that 2070 plan is going to be invested based on more growth now because you're young, you're accumulating money. And then when you get near retirement, you're going to have a different plan. So if somebody's getting ready to retire and you have no one helping you and you think you'll retire in the next 10 years, then you might choose a 2035 target. And then it's going to automatically become more conservative in handling that. When we work with people, we help you choose those types of investments. Your 401k is going to probably be, if you work for a company, the biggest place that you have. If you have other 401ks, we would roll those over into something, and then we would get them asset allocated and things like that. And so we go through things like that to help people get it together. Let me give you another example. You're close to retirement, 61 years old, you've got $1.2 million saved. I run into that. We've had great markets. The number one thing we want to do is make sure that we don't have a bad market. And over the next 5 or 6 years, you're $1.2 million because you've got it all in the S&P 500. And you say, well, yeah, but it's going up. Well, did you remember, the 2007, like 10 lost decade, all those kind of things where you've had your money at 2007, it took to 2012 to get back even. All right. And you're trying to retire. And then you have what's called sequence of return risk, meaning if you're retiring, it returns bad initially. So what we do is we start looking at income strategies. We look at what's the most important thing you have so far, which would be the 1.2 million, or is it the money you're saving? We may become more aggressive on the money you're saving monthly to make sure you have dollar cost averaging working for you. But at the same time, the money that you've got, we're going to get a little bit more secure. Had one of our partners that we do, investment partners, come on, and I'm going to say $4 trillion is the amount of money sitting in cash right now and sitting in banks. And you think about it, low interest rates, you say, yeah, but I'm scared of the stock market. And so some of the things that we do is we take cash and we dollar cost average it. If you have cash that you'd like to get in the market, but you're afraid, well, let's move it in over a period of time automatically. And if the market goes down, we're able to do that. So when you're at that age, you don't want to have too much cash sitting. You want to get it working for you. But at the same time, you don't want to have too much risk. We want to look at what are tax implications going forward. What are some tax implications? What about Roth conversions? What about buying ETFs on what non-qualified money, so we can get managed ETFs that have very little capital gains going along the way. So I can go on and on and on about this. And the last one is, this is one that if you're a widow and if you're in a situation where maybe you lost a spouse. I had a call yesterday where, it was the wife passed away and she was pretty much one dealing with all this stuff. And now he's having to deal with it. Didn't know about it, where accounts were, all those kind of things. You want to get, the stress of losing someone is bad enough, but you don't want to have the stress of being overwhelmed. All right. And a lot of times I see when they're overwhelmed, they just have their money sitting. And so one of the things that we do would be, first off, find everything, and we find it, and then we make sure everything is set. We also, the older you get, we want to make sure that you have a trusted person for your health and finances. And what I mean by that is like a family member that would be the power of attorney, whatever it may be. I've had, clients that, had Alzheimer's. All right. And had they not had this in place in advance, wow, what a problem that would be. So if you're listening right now, we do financial advisory. That is an example of how financial advisory works. If you would like to schedule a phone call to start to find out if we can help you, You can call 615-843-2999. You can also go to roymatlockjr.com, fill out one of the forms. We've got a lot of resources. Thanks for listening. We'll talk to you next week.